Employee Achievement Awards are a favorite EA exam trap. To be excludable from wages, the award must be tangible personal property. So no cash, no gift cards, and no cash equivalent prizes. And it generally has to be for length of service or safety achievement. If it's really a disguised bonus for performance, expect taxable wages. Now the limits. If the award is not under a qualified plan, the excludable amount is capped at $400 per employee per year. A qualified plan award is under a written plan that doesn't discriminate toward highly compensated employees. If an employee receives both qualified and non-qualified awards in the same year, the total cap is $1,600. Anything over the cap becomes wages. Athletic facilities are simple but sneaky. On-premises athletic facilities that the employer owns or leases can be excluded from the employee's income. Off-site gym memberships usually fail. So an employer-paid membership at a local gym is generally taxable compensation, even if it's good for morale. On the exam, watch the words, on-site versus off-site. Meals and lodging hinge on business premises and convenience of the employer. Meals provided on the employer's premises for the employer's convenience can be excluded from the employee's wages. But TCJA changed the employer side. Even when the meal is non-taxable to the employee, the employer's deduction is generally limited to 50% for employer-provided meals like an on-site cafeteria. Lodging can be fully excludable and fully deductible when it's on the business premises for the employer's convenience, and the employee must accept it as a condition of employment. Another exam tip: if the employee can choose cash instead of lodging, the exclusion generally fails. Lodging can cover the employee, spouse, and dependents and still be non-taxable when the rules are met. Educational assistance comes in two flavors. First, job-related education can be a working condition benefit with no dollar cap if it maintains or improves skills for the current job or is required by the employer or by law. Second, Section 127 educational assistance plans cover even non-job-related education, but require a written plan, non-discrimination, and a strict $5,250 annual cap. Excess becomes wages. That $5,250 cap also matters for student loans. Employer payments toward an employee's student loan can be treated as Section 127 educational assistance, but they share the same $5,250 yearly limit with tuition and books. Also, meals, lodging, and transportation are not qualifying Section 127 expenses. If you see those bundled in, that portion is taxable wages. TCJ also flipped two big employer-side deductions. Moving expense reimbursements are generally taxable wages to the employee now, even if reimbursed under an accountable plan. And qualified transportation fringes, like transit passes and parking, can still be excluded from the employee's wages, but the employer generally can't deduct the expense. EA exam questions love that mismatch. Employee exclusion stays, employer deduction goes away. What happens when an employer's cafeteria plan favors highly compensated employees or key employees for eligibility, contributions, or benefits? One option says the employer owes an excise tax. Another says the favored employees must include certain benefits and income. Another denies all compensation deductions. Another says benefits are suspended as a prohibited transaction. Think about it. The correct answer is that the favored highly compensated or key employees lose the tax-free treatment and must include in taxable income the value of the taxable benefits they could have selected or received. The tempting wrong choice is the excise tax idea, but cafeteria plan non-discrimination failures generally shift taxability to the favored employees, not a flat excise tax on the employer. All of the following statements about transportation fringe benefits for employees in 2023 are correct, except one. The choices include: transportation fringes are fully taxable and must be included in wages. The business can't deduct qualified transportation benefits. They can be provided through a bona fide reimbursement arrangement, and the employer can exclude them from wages. Which statement is the exception? Think about it. The exception is the statement that qualified transportation fringe benefits are fully taxable and must be included in wages. That's wrong. These benefits are generally excludable from the employee's wages, up to the monthly limits. The TCJA twist is on the employer side. The employer generally can't deduct the cost, even though the employee can still exclude it.